Let's also welcome in Andrew Holland, CEO at Avendus Alternate Strategies. He's joining us right now on the show. Andrew, good morning to you. Some green shoots after 4 straight days of selling that we've seen on the index, but that's a very short-term perspective. From a slightly longer-term, medium-term horizon, coronavirus, that's occupying a lot of mind space right now. Expectation, if you go back and historically map this to SARS, 7 months of SARS, post which you actually saw some bit of a pickup. We're still hoping for coronavirus to peak out, which has not yet happened. But if it extends itself beyond Q4, what are the implications, downside implications then?
So if it extends itself beyond March, obviously the situation would have probably worsened from where we are today. And I think globally, the kind of linkages will become quite severe. And obviously you'd have to start looking at reducing, not just earnings forecasts, but GDP forecasts. So I think the range is from the best case scenario. I want to say the best case scenario is that things start to resume to normal as a V-shaped recovery. Then it would knock anything from 0.2 to kind of 0.3 from GDP growth. If it extends onwards and becomes more severe, then I've seen GDP figures go globally actually halving from where we are today. So it depends on where you think the virus is going to continue or not, or whether they'll find a vaccine. And I think the problem for the markets is that at the moment we're working on the basis that it's under control. The number of cases has started to fall, and recoveries are improving. But of course, all of this data is coming from China, and so no one's really truly believing everything that they see, and that's what's keeping markets kind of more optimistic that it's all okay. But if it's not, then I don't think the markets globally or locally are factoring in the kind of disruptions you could have across many different industries. It's not just the kind of usual tourism, luxury goods, and travel, so and airlines. So that's where the problem lies, is that we still don't know, and the risk is obviously more to the downside than it is on the upside in terms of news flow.
Andrew, you make a valid point about how unpredictable the extent of damage and the extent of the spread of this would be. Now, 2 factors, Andrew. If we do not know when this coronavirus issue can come to an end, and therefore we do not know the question is therefore if that is the case, how do you pencil in the economic impact and the supply chain disruption impact that could come in for companies? Because we might well have the virus contained, but earnings of companies which might be affected because of the supply chain might linger on for at least a couple of quarters.
So again, it goes back to the timing of when you're saying that things are starting to recover, right? Because obviously if you're saying that it's contained, then factories will get back to work in China and so forth and so on. And that would be the good news. So I think what the market's saying now is that, even if you take March as kind of a month which will maybe still be a washout, that by the end of March everything will start to recover, and you'll get that V-shaped recovery both in kind of what's happening in China, manufacturing, and therefore the supply chain as well. So that's what the market is really banking on. And as an aside to that, if things don't work out, then the more optimistic forecasters will say, well, it's okay because the Federal Reserve and all central banks will reduce interest rates. So there'll be support that we just seen in Singapore, where they're increasing their fiscal deficit to support the overall economy. That you'll see more. So that will be more positive for the markets in the very short term. But again, it depends on when you think timing of this virus will be contained, or there's a vaccine come about, or we're all back to normal. So I think we're another 2 or 3 weeks away from knowing some of those facts. So I think the markets will play on the more optimistic side, obviously, that things are being contained and that will move forward. So the numbers I've seen are quite scary from the kind of disruption if you continue it on, because obviously auto parts, is a global factor, and Hyundai have shut their plant in Korea. So, it'll have a big impact on a lot of big heavy industries, which is not really being taken into account at the moment.
Mm-hmm. I think the bigger concern now, rather the new concern, is that coronavirus has not just disrupted supply chains, it's hampering demand overall, and which was any which way sluggish. So now it's sort of a double whammy coming in on the back of coronavirus with regards to the demand pickup. Andrew, we've seen a whole lot of liquidity being pumped in across the globe. Central banks are very accommodative, and much of that money has found its way into the equity markets. A little bit of hesitance right now on the back of whether or not investments into equity are the way forward, or maybe safer haven assets like gold. What would the call be now in terms of incrementally adding more money into the portfolios from the equity standpoint, be it India, primarily India specific, to get the portfolios spruced up?
Yeah, so I think this is what I was thinking, is that I'm going to work on the basis of the base case scenario, or the best case scenario is that the virus will be contained between now and the end of March. If that's the case, then we go back to where we were before at the beginning of the year, which is that global growth will start to pick up, led by the US and Europe and UK, and that would be good for emerging markets and emerging market flows, and India would be a beneficiary of that. So that scenario hasn't gone away from us. I think what you would see is that obviously interest rates would definitely stay lower for longer, both globally and locally. So therefore you would see money moving more towards equities. I think for India, I think maybe the economic recovery, before this virus, we'd be saying, okay, by the end of March, are we seeing better signs, more green shoots, that demand is picking up? Maybe this has just delayed that by an extra month or so. So again, I'd probably stick to the large caps at the moment, the best in terms of each of the sectors, in terms of the stock picking, until you see real evidence that the economy is starting to slowly pick up before looking down at the small and mid caps. I mean, undoubtedly there will be some very good small and mid caps which are are valued very cheaply at the moment. But I think for a broader move for these sectors, then I think you'd need to see signs that the economy is recovering, and I think that's just been delayed by the virus by an extra 1 month or so.
Okay. Andrew, the last time that you were in our studios, you had, this was I think in December, you had spoken about how even if there is an intermediate pullback in the broader markets, you don't know if that will last or no. We've seen that happening now, right? January had that intermediate pullback in mid caps and small caps, which has cooled off now, and the consumption names and the others which are heavily priced are moving higher. Do you think that would continue?
I think in the very short term, yes, because I think, as I've said, I think we want growth with safety, and that's what you're getting in the kind of the larger consumption stocks, but also companies or banks within a sector which are continuing to take market share against the weaker competitors. So that's what I mean in terms of the best in class in each of the sector. But I can't bang on the table now and say all these green shoots mean that the economy is going to start recovering. It is going to be a kind of a U-shaped recovery. Anyway, it was always a U-shaped recovery even before the virus. So it's going to be a slow grind, and I think investors will probably want to see a little bit more evidence that this is that what the budget did, but in particular all the heavy lifting by the RBI is starting to see people going out and spending, companies starting to borrow, and I don't think I have enough evidence to give you at the moment to say that that's really what's happening. So until that I can, then mid and small caps, whilst yes it had a good January, it's given quite a lot of that back already this month and underperformed the indices. So I think for the time being, it's probably better to hide in the top quality growth stocks, even though they are expensive, because obviously they will continue to do well, even in a more benign kind of economy at the moment.
Many of those growth stocks, Andrew, are primarily, pocketed either in the financial space, in the BFSI space, or in the consumption space. The ones with the extremely stretched valuations. These are probably the primary two pockets to look at. Do you feel there's anything outside the scope of these two segments that one can look at being, even if you have to be slightly picky and choosy about the kind of names you invest in, but, there is a big, larger universe out there?
Yeah, so I mean, we'd become more constructive on telecom, a number of years back, but more recently on pharma, where we think the worst is, or the worst was over. But obviously, that thesis is fraught with the fact that if this virus continues in China, then there could be disruptions to the pharma companies, and that would have an impact on their earnings, which would be a dampener in the very short term. But I think pharma is a sector now which is getting through some of the problems, which have haunted it for years, particularly in manufacturing and regulation. So I think a lot of that's priced in. So if the virus goes away, then I think you'll find that the pharma companies would be one sector which I think will deserve a lot more attention, and probably will see a lot more investors moving towards the sector, because it's looking reasonably valued at this time, given all the problems we've had in the past. I think it could be a sector which could re-rate. But I say you had that short-term kind of worry about supply of products, which would obviously have an impact on the ability to kind of produce the products that they have. So that's the only short-term negative I can see at the moment.
Andrew, it's a small space, but I wonder whether large money bags are now talking about it actively, and that specialty chemicals somehow has seen a flurry of good results and some fairly high HNI activity. What is it that a large company or a large fund like yours thinks about when it looks at that space?
Yeah, it's not a space that we've really kind of been looking at, because we tend to look at the largest companies, and they don't really kind of fall into it. I think a lot of it's linked to what's happening in China, and again, I think that if this continues, then there could be disruption in the chemical sector as well. So it's not a sector I know well, so I can't really comment in great detail. But it's not on our radar. It's more of kind of small and mid cap in terms of the stocks to our mind. Yesterday
we were speaking to one sell side head of research, Andrew, and their opinion was, as also the companies in the insurance space having said, that this whole changes that we've seen will not really impact earnings too much. However, we have seen prices come off. Are you constructive on the pocket, and maybe not from an immediate term, but from a slightly longer term perspective, or do you think there are better bets to take as opposed to maybe life insurance?
Yeah, insurance is, again, is a growing sector. So it's all about valuations. Valuations have been rich. So it's an opportunity that we're looking at, but it's nothing that we've been investing in the recent past. So it's a sector I think has great long-term growth potential, but again, I think valuations are a little bit stretched in the medium term for our liking right now. So we'd have to see a little bit more correction before it gets back onto our radar. But as a long-term view, we like this sector.
Okay, I just want to put up IRCTC. I think that's at 1700 now. So that stock's along with the entire theme of digitization and tapping in consumers through the digital route, be it the likes of an Affle, which also was a recent listing. India Mart Intermesh post its listing had a spectacular run. Affle is now above 2,000, approaching 2,100, and India Mart Intermesh is in its league of its own. So that's approaching 2,500 now. Andrew, is this a theme that works well? Even though now, again, when you're talking about those valuations being stretched, they are stretched, but do you have that kind of growth visibility for some of these companies to say that, you're going to see a CAGR of 10 to 15% here, and therefore P multiples on a discounted cash flow basis from a 5 to 6 year period, if you extend these kind of earnings, is still looking okay?
On consumer stocks?
These stocks like Affle, IndiaMart, Intermesh, IRCTC, more of a digital play.
I must admit I don't look at some of those companies, so I can't really tell you what their earnings are. So, sorry.
Okay, Andrew, this just one follow-up to that. Some of these businesses are nascent in India. They might actually grow big. Do you fear losing out on some of these because you, by virtue of your size, wouldn't necessarily have to look at only the larger ones?
You see, it all depends on what you're thinking in terms of the company. So, if it's a mid-cap company now becomes a large cap or falls into our radar, then we'll obviously look at it then to see what the kind of growth rates could still be. But it doesn't necessarily mean because it's become we've missed out. Yes, you might have missed out from moving from a small cap to a large cap. It doesn't mean that large caps can't grow themselves. All you have to think about is really kind of Apple or any other company in the US which have done well. You've made lots of money as a large cap. So I don't worry so much about that part of it because it's not part of our fund strategy to do that. So I'm not trying to compete in small and mid caps with the strategies that we have. So yes, from a personal viewpoint, it's always nice to have those stocks, but from a fund viewpoint, we're not looking at those kind of companies.
Fair point. Yeah, as long as the larger ones are doing well. But Andrew Holland, take a moment to thank you for joining in today and giving us your thoughts. Really appreciate your time.
Pleasure.